All right, what's up, tycoons? What's up, traders? Super excited for today's video. Going to give you guys a really important video for the bulls and the bears. All right, there's a lot of crucial data that people aren't looking at, so I'm going to help point out some of this data, break it down, and explain to you guys why it's important. So this first chart that we're looking at is the National Financial Conditions Index. Okay, that's going to be here in purple. And then we have the Adjusted National Financial Conditions Index here in orange. Okay, they're both very similar, but obviously one is just slightly adjusted from the other compared to the S&P 500 SPS index. So what we can see is as you get a rise in financial conditions, right? And this is Jerome Powell's pretty much goal and job right now is to tighten financial conditions and cause these national financial condition indexes to rise. So I just want to point out that each time, we hit a bottom in the S&P 500, it also coincides with hitting a top in the national financial conditions. Okay, so when financial conditions are tightening and on the rise, you're seeing the S&P 500 produce bottoms, create new bottoms, right? And that pattern keeps repeating itself. Now over here, right, when we got the large rally, okay, and this was pretty much one of the most historic bear market rallies ever, this time period right here, we can see that national financial conditions actually bottomed out, right? And they hit a bottom right here. Now, this is very close to the Jackson Hole speech, all right? Now, the reason that this is important is because we can see how much the stock market tanked after the Jackson Hole speech, right? Well, if we take a look, we have actually increased the federal fund rate, right? Like, they've done multiple rate hikes afterwards. And the Fed fund rate has increased a lot since then. But what we're seeing is that financial conditions are actually still hitting that same bottom that they hit previously. So it's a weird time right now because, the stock market was rallying. We have been pulling back, obviously. And I expect on the next time that the national financial conditions are updated, we're going to see it start to rise and we're going to start to see it curl back up. But what's crazy is that we could even hit these same conditions when the Fed has increased the rates at such an extreme level, right? It's really a historic and very aggressive level. The rate, the pace basically that they are increasing these rates. So this is something that you guys want to pay attention to, and really look at. It's not hard to find, NFCI, ANFCI, and then S&P 500, right? You can use SPX or SPY. Now, the next chart we're going to look at, this is why there's a huge potential for a massive crash. Okay. And this is going to be some of the bearish data that we're going to go over first, and we'll get into the bullish data later. But take a look at this. Okay. This is 2008. All right. This is the 2008 here in yellow versus the current stock market right here in white. We can see that December, all right, as soon as December ended, and really through January and February was just absolutely brutal, right? And we've been following, look how much we're almost, it's crazy how much we're similarly following the patterns of 2008. And a lot of people are looking at this, right? A lot of people are paying attention to the data from 2008, and they're comparing and they're looking at all of this, right? So this means retail traders, this means financial institutions, and if history repeats itself and things look similar to the charts as they have been in 08, we could be in for a disastrous, I mean, completely disastrous Q1 of 2023. If we take a look at the next slide, this is going to be the volatility index, right? Which is the VIX, okay? And we're looking at the same thing. We have 08 here in blue, right? And then we have the current, VIX right here in white. And we see, if this thing skyrockets through December and February, this is going to cause massive pain in the market. And this is going to be a capitulation cycle. Now, there's no guarantees, but again, we're just comparing stuff to 2008 and looking at the data, and the charts just look so similar. So if we see VIX skyrocket, right, and it doesn't even have to go all the way up to 80, it doesn't have to go all the way up to 70. If we see the VIX get to 50 or 60, even 45, that's going to cause massive pain in the stock market. So, I think a lot of people might not be prepared for this. So I'm trying to present some of this data so that you guys can, just be prepared and realize that now is a time when we really need to have patience, right? A lot of the indicators, especially the bond market, is predicting a recession in 2023. Some people say we've already had a recession. I would say you're not wrong, right? Technically, we did have a recession in 2022. We had two negative quarters of negative GDP, but the labor market and the job market has been too strong. So the government and Biden does not want to say that, we've had a recession. If we take a look here, this is the equity put to call ratio, and we're seeing it at historic levels right now. It's up at 2.03, right? So this basically means that there's two puts held for every single call option in the market right now. And if you're unfamiliar with those terms, puts are basically option contract bets that the market is going to go down, and call options are, option contracts betting that the market is going to go up. So being that it's at 2.03 right now, there is a massive, and I mean massive potential for a short squeeze. Let any good news come out, all of these people are going to get squeezed out of their put contracts, and that's going to cause a gamma squeeze, which, you may not be familiar with, but that's basically like a short squeeze, but in the options market, right? Where there's a high number of option contracts and then they get squeezed out. That would be a gamma squeeze. Okay, so that is a little bit bullish right there, but it's also very bearish. This shows and highlights how bearish people are in the market when it comes to retail and institutional investors, that we have a 2.03 put to call ratio. That's insane. Normally that's very bullish, and you see it on the other side. You see calls much higher. Now, right here, what we're looking at, okay, is going to be the 10-year 3-month treasury yield and the 10-year 2-month treasury yield. Every time that these are inverted, the stock market has, it's basically predicted a recession every time within the following 3 to 9 months, right? So if we look at this example here, okay, this is when they're inverted. I've circled it in red, and we see the stock market continues to go up a little bit, and then we get a massive crash. Right here, they have been inverted for a little while now, for at least a month or two, that these yield curves have been inverted. So the stock market has gone up a little bit since the initial yield curve inversion. We've started to pull back, but we have to remember that these are a little bit of lagging indicators, right? And it predicts a recession 3 to 9 months in the future. So if the yield curve inversion started in October or November, right, we're possibly going to see a recession in February all the way through September of next year, right? Is when we're looking at potentially recession. Now the market is forward looking, so you have to realize that if it seems like we're going to have a recession, the stock market is going to price that in a lot sooner than the actual recession comes, right? So that means that if we're supposed to have a recession in March or April or in the summer, right, in Q1 or Q2 of 2023, the market is going to price that in before, and you're going to see lots and lots of pain. We'll go on to some further slides and just show you guys some further examples of every time, so here we're inverted, right? And what do we see? We see that the stock market goes up a little bit, and then in the future, 3 to 9 months later, there's a massive crash, right? Over here, we see the same thing. We continue to go up for 3 to 9 months, and then boom, there's a massive crash, right? Even the next slide shows the same thing again, right? And we're seeing, all right, we're inverted here, we go up a little bit, and then we get a massive crash. Over here, we're inverted a little bit, we go up, and then we see a massive crash. So the bond market is much, much more massive than the stock market is and will ever be. So you have to realize that the bond market is, pricing in a recession right now. It's going to reflect in the stock market eventually. So, there's no guarantees, but so far, this indicator since about 1955 has not proven wrong, and it's been accurate 100% of the time, predicting a recession 3 to 9 months out from the yield curves inverting. Now, what we're looking at here is the federal funds rate, okay? And this is the Volcker time period, okay? I just want to show you guys how elevated it really got and how low we are right now, and people are just panicking and losing their mind over the Fed funds rate. There's potential, right? Like the markets are saying that it could come up to 5%. It could come up to 5.2%. No one knows for sure, but the Fed is on a very aggressive path, right? And again, this is the Volcker area, and a lot of people are comparing today's timeline of inflation to the Paul Volcker era. So the next slide is going to help us, just illustrate this a little bit more and really understand how much the Fed controls the market, right? A lot of people don't realize that it's basically the Fed that determines if markets go up or if markets go down, right? we can see over here that the rates drop, right? So this is the federal funds rate in blue here. This is the S&P 500 in orange. And we can see that, as soon as the rates start dropping right here, we see we're getting a bull market, okay? And we start rallying in the S&P 500. Now, of course, we get the COVID crisis, but look at what they do. They cut rates all the way down to zero. And this is free money, guys. This is free money. This is large institutions able to take out hundreds of millions of dollars, billions of dollars in loans for free without having to take out massive interest rates, right? And so what do you see? You see once we get the free money and once you see the Fed fund rate drops and completely tanks, you get a massive bull market in the stock market, right? And this is even with the whole world shut down, the global economy in panic, right? And still we're getting a massive market rally, right? Huge supply chain issues that ultimately led into our inflation. And then right here, right around March, is when the Fed finally wakes up. And it's not a coincidence that as soon as the rates start to go up, what do you see? You see the stock market going down, right? So, you really have to realize that there's a reason there's a saying that you can't fight the Fed. And, anytime you try to fight the Fed, it's not going to work out in your favor, right? People who are trying to fight the Fed and short the stock market when there's all this free money going around, what you're not realizing is that this is allowing companies, growth companies specifically, to take out massive amounts of debt to finance their future growth at, basically for free, right? And then they can just pay it off in the future after they've got their growth and after they've achieved massive profits, right? Because a lot of times growth companies, they'll be unprofitable companies and you're investing in the future growth of them, and they're saying, oh, well, these companies have as much funding as they want. They can get as much money as they want. And once they, get enough funding to achieve their goals, then they'll be in massive profit and see massive growth, be able to pay off these loans. And then now we're seeing the exact opposite. We're seeing the Fed fund rate, skyrocket up at historic paces, and we're seeing the stock market continue to crash. All right. Now, this is a very similar chart, except this has CPI on there along with the Fed funds rate. And so what we're seeing here is basically, you can have CPI dropping, but the stock market will still drop as well, right? And that's what we're seeing today is, the past two inflation reports have come in down and it's established a trend that, hey, maybe we have seen a peak in inflation. But as soon as rates drop, that's when the market goes bullish, right? Rates were still very high over here. They were high over here. Even when they came down and dropped right here, you saw the market tried to rally a little bit and inflation went down a little bit more, but then they raised the rates some more and the stock market just continued to fall, right? Notice how there's a very sharp decline right here. As soon as they raise the rates back up, then, rates drop. We see the stock market go back up. Rates go up, stock market goes back down, and it's not a coincidence, guys. Inflation can still be dropping, and I think that that's what a lot of people are going to be seeing and predicting is that, okay, we hit our peak in inflation. In core CPI can still be dropping, but the market can still go down as well if the federal fund rates are not going down. And, recently the Fed just spoke again and Jerome Powell spoke again. And, they came off very hawkish saying that they're going to keep rates higher at a longer pace. And that's going to hurt the stock market more. And that's why we're seeing such red. But as soon as those rates reverse, right, that's when the stock market has a chance to go bullish, right? And this is a very good example of it, right? CPI is going down, stock market's going down. But as soon as the Fed fund rate really starts tanking, that's when you see the stock market truly start to rally. And this is the 80s right here, right? This is the Paul Volcker area. If you look at the timelines, it's 82, 83, 81, and 80. Okay, so it's very prevalent to, what a lot of people are looking at right now. They're comparing a lot of the times to the Paul Volcker times. Over here, we're looking at some of the same things, but we're looking at it on our current timeline. Okay. And so this is basically 2020 to 2022, right? And we're seeing, inflation is going up, right? Inflation is going up, but it's not really, causing the market to drop too much, right? We're seeing that the market is still slowly going up, climbing at a slow pace. And then we get the COVID crisis right here, right? So we see inflation drops down, obviously, and, that's a result of COVID. But then this free money comes out and the stock market goes up, inflation goes up, and none of it really starts to go down until we start ending the printing of free money. The Fed finally wakes up, federal fund rate goes higher, and we're seeing, inflation is still going up, the stock market's going down, and it looks like we finally peaked, right? We're coming down. There's no, guaranteed signs, right? We have seemed like we peaked before and then made new highs. So we really have to look at the data over the next few months. But it does suggest a trend, right? And we are finally starting to trend down. But inflation can be very sticky, and we may stay up here at elevated levels, and this may cause the federal fund rate to stay at elevated levels as well, causing the S&P 500 to further decline, right? Remember the very first couple charts that we looked at, comparing it to the '08, there was a massive crash in Q1 of the next year, of the following year. So we have to be prepared for that for 2023, that there's a potential for a massive crash in Q1 of 2023. Now, one thing that really helps with gauging market sentiment and really taking a look at, whether the stock market is bullish or bearish, and whether, you can ask yourself some questions if this is justified, is by looking at this ticker here, SPX A50R. This is the percent of S&P 500 companies trading above their 50-day simple moving average. You can see here previously, once we hit these elevated ranges, it's really suspicious, right? This is 90% of stocks in the S&P 500 trading above their 50-day simple moving average, and we have federal fund rates skyrocketing, right? So it's very suspicious, and it's a good time to be cautious in the market when you have 90 to 92. We recently hit 0.92. 92% of all companies in the S&P 500 were trading above their 50-day simple moving average. I've showed this chart a couple times in my previous videos, and it's a really good gauge for sentiment, right? And when we're down here, and when there's no companies, pretty much no companies, right? 2% of companies trading above their 50-day simple moving average, maybe that's a time to look to start going long, saying, hey, maybe some things are a little bit too oversold, and there could be a trade potential. And then it's up to you to go and look at individual equities within the S&P 500 that you think could have potential, or possibly go into one of the S&P 500 ETF indexes. We'll go on to the next slide, and it's actually going to be the same thing, but instead of the 50-day simple moving average, it's going to be the 200-day simple moving average right here. Okay. And the range you want to be aware of and a little bit cautious of in this one is basically going to be right in through here. Okay. It's going to be about 50% to 65%. You have to realize we're in a bear market. If we're in a bear market, it's a little bit cautionary that over half of the companies in the S&P 500 are trading above their 200-day simple moving average. Now, the reason I look at the 50 and the 200-day simple moving average and the percentage of S&P 500 companies above is because there's tons and tons of institutions specifically, as well as retail traders, that simply buy something if it's above the 50 SMA and if it's above the 200 SMA. It's a time proven investment strategy that a lot of people use, a lot of funds use, and you can see a lot of money dumping into things whenever this happens. But it's good to know levels when it's like, okay, hey, too many companies are over the barrier right now. And so really, about 50 to 60%, when you see 50 to 60% of the stocks trading in the S&P 500 above their 200-day simple moving average, and we don't have really any good economic news, and the Fed hasn't started cutting rates, then it's a good time to be cautionary and maybe protect your trade, or look at, some type of risk management for your portfolio. We'll go on to the next slide here, and we're going to actually take a look at some individual equities, right? And we're looking at Tesla right here. Okay, and this is Tesla on the daily chart. We have the RSI down here, the relative strength index, and the DMI. The DMI is really nice. The way I have it set up here is you can see who's in control. Okay, the red is sellers. So clearly sellers are in complete control of Tesla, and it's no surprise that we're just seeing Tesla completely tank and drop, right? The blue is kind of like the average, and then green is buyers. So buyers are nowhere present in the market right now for Tesla. We're seeing, sellers are complete control. We look at our RSI, or relative strength index. It is super oversold. It's hit this level multiple times in the market. And actually today we broke through these levels, and Tesla went even lower. So it's just wild. There is potential, as I went over that put to call ratio, for a massive short squeeze here. So many things are oversold, right? And I'm not telling you that stuff is oversold because I want to. We're just simply going by the data, by the technicals, right? These things are literally the technical definition of oversold, trading below 30 on the RSI. So you have to be cautious if you're trying to aggressively short things. And you need to be cautious if you're trying to go long. Right now is a really good time to have patience in the market. We'll go on to the next slide, and what we're looking at here is actually Amazon, guys. Amazon, would you believe it if I told you that Amazon is trading below its COVID lows? Remember when everything tanked during the coronavirus crisis, and markets were just plummeting? Amazon currently is trading below there. Now, what's insane about that is that the company itself has improved, right? Their margins have improved. They've gotten better at increasing profitability. And so, what you're able to do now is you're actually able to buy a much better company at the same valuation or lower than the previous valuation of the coronavirus crisis, right? Of the COVID crash. So, there is lots of potential, right? Especially if you have long term mentality and you're looking over the next 20 years. There's lots of gems out there that you can start getting into, right? And that doesn't mean that things can't crash more, right? I just showed you guys a lot of data that, hey, Q1, Q2 of 2023 could be really disastrous, and that the bond market is pricing in a recession. So things most definitely can go down. But what you have to do is you have to start spotting some of the things that are oversold and some of the things that aren't really making sense, right? I mean, it doesn't make sense that Amazon is, trading below the prices of the COVID crash when the company itself has actually improved, right? And now they're starting layoffs, so they're going to be even leaner, right? They're going to be more efficient at making those gains and increasing those margins. And now they're doing it at less of a cost by decreasing, the amount of workers that they have. And we're going to see that. I think we're going to see a lot more layoffs in 2023, unfortunately. I do want to highlight on the relative strength index of Amazon, we actually do have a bullish divergence, right? And so that's where the stock price is going lower, creating lower lows. We have a low here, we have a lower low here, and then we have a low here and a higher low here. It's an indicator that we may see some bullish activity in the future. It's not a guarantee. No indicator, no strategy is 100%. But this is a strategy that I like to look at frequently in the market. We'll go on, and now we're going to look at a little bit more of some bullish data, right? And so what I want to highlight here is that the market bottomed before Volcker shifted tactics. The entire decline was erased in 4 months. So right here we have 27 months of pain, right? The S&P 500 peaked, and then we have 27 months of pain, right? And then the entire decline was erased 4 months after. Okay, 4 months it got all erased, right? And then we hit all-time highs 1 month after Volcker considers ending the inflation war, right? So we see Volcker starts, considering ending the inflation war and basically just saying he's going to cut rates, right, and shifting tactics. And we see the S&P 500 actually hit all-time highs. So, there are a lot of bearish or bullish cases out there. This is one of them. So I went over a lot of bearish things in this video. But again, if you're a long-term investor, these are generational wealth building opportunities, right? And it just depends on your time horizon and your amount of patience. None of this is financial advice, but this is all just data, right? I'm just representing and presenting data to you guys for you to look at and use to, inform yourselves on some of your future decisions. We'll go into the next one, and we're looking at how the equity returns, and basically this is stocks, okay? They were strong under Paul Volcker, all right? The annual S&P 500 price return versus the CPI. All right. The inflation war average was 11%, and the Volcker era average was 13%. So we can see that, it's actually going up a little bit, right? And here's the inflation war average right here. This is CPI year over year. This is the S&P 500 we have on the top. And CPI year over year went down, right? And so CPI was going down, inflation was going down, and meanwhile stocks were going up. Okay. So again, just a little bit more of some bullish data right here. And this is a fair value based off earnings per share for the year end of 2023 at 47.50. Okay, so this is roughly 4,800 on the S&P 500 by the end of the year of 2023, and this kind of just gives you, a little bit of a valuation and how it would work, right? We have the earnings per share. All right. And then we have the price to earnings ratios. Okay. So right here, we can basically see that we're estimating a 2024 earnings per share of $250 in the S&P 500. And then you multiply that times the year end price to earnings ratio, and you get a range right here of about 46.25 to 49.38. And your midpoint is going to be 47.50. So that's possibly how we could actually see 47.50, maybe even 4,800 in the stock market by the end of 2023. You have to realize, the bear market is going to be excruciatingly painful, but once it does end and once we make it through that, we are going to go back to a bull market, and there is a potential for a V-shaped recovery. no guarantees. It's going to take a lot of patience. And, we may not see this at the end of 2023. It may take until 2024, may take until 2025. I don't have a crystal ball into the future, but hopefully you enjoyed this video and learned something new and you enjoyed some of the data that I presented in this video. If you did, smash the like button and subscribe to the channel because I'll be dropping content like this every single week.